You mentioned, I think 2 or 3 times, it's not a home run deal. Why is that a problem? It doesn't have to be a home. Here's the point. It doesn't have to be a home run deal. You're kind of feeling like you're stuck a little bit in analysis paralysis. Before you enter a deal, you want to determine the exit. Obviously, we don't know where rates are going to be in 5 years, but the deal still has to work. If rates are 7 or 8%, like, you have to stress test the deal. This deal fell out of contract with 2 other operators that couldn't raise the down payment money they needed.
I think that's one of my biggest hangups right now is, will I be able to fund it?
Whenever we do seller finance deals, the longer we can get on the term, the better. You have more breathing room, more flexibility. You're less prone to market adjustments. I can offer the depreciation so that somebody that does have high income can take a paper loss, and that helps them. Detach yourself from the outcome, despite how difficult that may be, because this is your goal and this is what you're focused on, and you've knocked on the door numerous times and you've been very close. Detach yourself from the outcome, which you have very little control over, by the way. All right, Dan. So for anybody listening, I want to frame this and put it in his perspective. The $3 million deal that Dan's been working on, he presented on that yesterday on our Storage Wins coaching call, and he got a lot of really valuable insight and feedback from myself and others in the community. And what's interesting is Dan was viewing this as a home run. And I think a lot of the insight and feedback and questions we asked and some of the potential challenges that we raised have caused him to maybe take a little bit of a step back, not be as enthusiastic about the deal. And so with that said, Dan sent me like a long email. And Dan, you said you're kind of feeling like you're stuck a little bit in analysis paralysis.
As usual, that's where it seems to end up for me pretty often.
All right, so I got your email open here, and it was a long email. So let me kind of address it. Let me address this first of all, because you mentioned this a couple times in the email. You mentioned, I think 2 or 3 times, it's not a home run deal. And the first thing I thought of, is that right? That you no longer feel it's a home run deal?
I think it's a solid deal.
Okay, perfect.
As far as whether it's life-changing home run, I don't think so.
Great, pause it there. Why is that a problem? It doesn't have to be a home. Here's the point. It doesn't have to be a home run deal.
Yeah.
So that's just big picture. And I want to dive into some of the actual real concerns you have. And one of those real concerns is whenever you enter a deal, in fact, before you enter a deal, you want to determine the exit. In other words, how are you going to pay back the seller? In this case, it's a seller finance deal. So how are you going to pay back the seller? How are you going to pay back the bank? Basically, how are you going to pay back the lender within the term that you have? And in this case, I think, Dan, it would be a 5-year term? Okay, so it's a 5-year term. So this is a cash flow play. So from day one, Dan is getting into this deal without any money out of his pocket. However, it's not really an equity or upside play, meaning there's not a big growth in value per se in a 3, 4, 5-year period. Is that right, Dan?
Right.
So the concern for Dan, it's like, hey, making sure that he can structure this in a way where he still benefits from the cash flow from day one, but that he's got breathing room when he has to exit this and pay off the lender, the seller. And you can do that by refinancing the property, right? But if you refinance the property, and Dan, I think you're talking about a 5% interest rate that you have negotiated with the seller, correct?
Yes.
So obviously, we don't know where rates are going to be in 5 years, but the deal still has to work. If rates are 7 or 8%, like, you have to stress test the deal. And can it still work from a refi perspective? And if not, then you got to sell it. But it's kind of tight. If Dan is buying this at $3 million, and let's just say we project that the facility is going to be worth $3.2 million in 4 years or in 5 years, that's not an equity upside play. Like, a couple $100,000 in equity can get eaten up pretty quickly when you factor in a 5% broker commission. You factor in just things like that. It starts to really eat into the deal. Not to mention if you have to pay a private lender because you need a down payment. So that's the real concern, Dan, that I wanted to highlight. And it's not so much a concern. It's just how do we structure this in a way that it makes sense? I wouldn't worry about the fact that it's not a quote unquote home run, right? It's certainly better than it's certainly better than a single, right? I mean, it's a deal that you can get into that it doesn't, correct me if I'm wrong, it doesn't appear like there's a whole lot of capex, right? In other words, capital expenditures, like you're not having to dump hundreds of thousands of dollars into this deal, right?
Right.
So it aligns with your buy box blueprint. And that's one thing that, if you're watching and listening to us, you want to filter these opportunities through your buy box blueprint and ask yourself, okay, well, does it fit? If it doesn't, do I want to adjust my buy box blueprint because of X, Y, and Z? Or does this make more sense to pass on it or maybe to take it down and wholesale it? There's different options. If it does fit your buy box blueprint, like in Dan's case, he's looking for cash flow. And so this deal checks off that box. I think you're also looking for a relatively light value add, right? You're not looking for some major operational overhaul because right now occupancy is at what?
The 82%.
Okay, so this checks a lot of the boxes. So the first hurdle to overcome for you is this mindset of like, oh, it's not a home run. So what? Like, not every deal is going to be a home run. In fact, most won't be a home run. But is it a solid single? Is it a solid double? Could it become a triple? And I think this deal, based on the feedback and insight that others provided and me getting my eyes on it, it appears like it's a solid deal from a cash flow perspective. It gives you the opportunity to get into your first deal without any of your own money. Now, we still have to figure out, I don't want you to do the deal just because the cash flow works today, because when you sign on the debt, even if you're not personally guaranteeing it, like you want to figure out how to make good on that within that 5-year period. So the first thing I would do that we talked about yesterday is, and I don't have my notes in front of me from yesterday's call, but the first thing I would do, Dan, is make sure that I'd like to see if you can negotiate a longer term.
Right.
Okay. Whenever we do seller finance deals, the longer we can get on the term, the better. You have more breathing room, more flexibility. You're less prone to market adjustments. Like if you can get a 10-year note on this thing, I think you're in really, really good shape. Because now you allow yourself for equity growth. You have more time. Like if rates really come down and it makes sense to refinance, like maybe rates get below 5 at some point in the future. I don't know that I anticipate that, but maybe they do. And it makes sense to refi. Now you cash out the seller and now you get new debt for 3 years or 5 years and you get to extend it. So as a general rule of thumb, I don't like to agree to a term anything less than 3 years. Like meaning I have to pay off this note. It's what's called a balloon payment. Ideally, if I'm working with a seller and seller financing, I want minimum 5 years. But if I can get 7 to 10 or 7 to 12 or 15 or 20, amazing. So I think that's the first thing, Dan, that you may want to really hold firm on, because if we can't restructure the deal in a way where you can comfortably exit this in a 5-year period, then maybe it's not one that you pass go and collect $200 on, to use the Monopoly analogy, right? Even if the deal cash flows today. I think we need to really think about tweaking the structure to make sure, and one way you could do that is by getting a longer term. Another way you could do that is, I'm thinking here, like, it'd be great if you could put less down, but if you put less down, that's more that you're going to owe. Right. So that, I don't know that really accomplishes it. So let's do this. What we had suggested is for you to get on the phone with the broker and assure him that you are the right buyer for this, because for perspective, and so everybody knows, this deal fell out of contract with 2 other operators that couldn't raise the down payment money they needed. And Dan, you've determined that this deal can afford a private lender. You can go private money or you can go equity partner. So, yes. So that's another thing that fits your buy box blueprint. Okay. So my suggestion is to get on the phone with the broker and actually share with him your numbers. Like, share with him your underwriting spreadsheet and say, hey, like, bring him in as a partner in the transaction. And that's what a broker is. Even though the broker represents the seller and has a fiduciary responsibility to the seller, The broker wants to see this deal go through because that's how they're going to get paid their commission. And the broker doesn't want to tie this up for another 60, 90 days, only to have it fall out under contract. So if you've built a relationship with a broker, they're going to be an advocate for you to the seller. And they're going to sell you as the buyer and your offer / terms to the seller because they want to see it close. Now, a really, really good broker is going to fight for the seller and get the best possible deal. But this is where you need to feel really comfortable going into the deal. And the caveat is, I don't want you to have analysis paralysis here. Like, we got to step up to the plate and swing the bat here. You got to trust your underwriting and trust that you've got the right process in place. But I think step one is to get on the phone with the broker and bring them in as a potential partner on the solution to the whole, how am I going to exit this thing comfortably in 5 years? And show them the numbers. I've spoken a lot, so let me kind of pause there for any insights or reflections you might have.
Since the seller is not or hasn't yet requested a personal guarantee, would I just note on the LOI that it would be a non-recourse loan?
Yes, 100%.
Yeah.
100%. Why would you offer that up if they're not, you know what I mean?
Yeah.
So are you clear on, we don't have a solution yet per se, and we might not arrive at a solution on this call, but are you clear on what the next step is? That's my goal for you here, is to quell your concern about this not being a home run. I think we've talked about that at length. That's okay. This still checks a lot of the boxes, and we got to sharpen the axe a little bit in terms of fine-tuning the structure and the offer to give you breathing room and have you walk into this thing confidently, knowing that you have a plan in place and you have multiple exits.
Right.
Okay.
Yeah. After yesterday and getting feedback on this deal, I think one of my hesitations or apprehensions is being able to attract an investor or investors to fund it, and if it offers good enough upside to attract them, and if the returns aren't quite there, I could offer depreciation. I think that's one of my biggest hangups right now is, will I be able to fund it? And I guess you won't know unless you get it under contract and try to.
That's right. I mean, look, you've looked at the spreadsheet. Your eyes are probably like going cross-eyed at this point because you've looked at the numbers so much, but you're right. You're not going to know until you start presenting the opportunity. And I love the fact that you're thinking creatively. What you just said is, hey, I can offer depreciation because if I'm not expecting a high income year, I'm not, this is my full-time thing and this is what I'm focused on. I can offer the depreciation so that somebody that does have high income can take a paper loss and that helps them. So that is a creative way to sweeten the deal for somebody if the returns or the numbers aren't quite what they're looking for. Now, because this isn't an upside equity play, it has to make sense from a cash flow perspective to somebody. But here's the great news, Dan, is that based on what we ran yesterday, this deal can afford a private lender, at least based on everything you've shared on paper. Right? Now, I realize that doesn't give you the warm and fuzzies because you feel like partnering with somebody's kind of spreading the risk. And then now, and I get it, man. Like, I want you to feel comfortable, and I would never encourage you to do something that you just at your core doesn't feel right and is not aligned. But that's why banks look at debt service coverage ratios and to make sure that the deal can comfortably afford the debt. And so we would need to look at the debt service coverage ratio just as a stress test for you with the private lender to say, hey, this is the net operating income that we expect this asset to produce. And then with the debt service to the seller and the debt service to a private lender, this would be the DSCR. Not that a bank is asking for this, but so that you know what that might be. Now, keep in mind, one potential challenge with a private lender who's putting up $1 million, and that's a lot of money, is that now they're going to be in second position. And that's something we didn't discuss yesterday. That presents, I think that's probably one of the bigger obstacles if we don't go with an equity partner and we go with a private lender, and not to give you something else to be concerned about or worried about, but, and I'm not saying it's impossible. I'm saying it's going to be more challenging to find the right private lender who isn't even in first position.
Right.
So can you
about that?
Yeah, and that's something that honestly, like, we should have brought up yesterday, but it's coming up now, is if you go private money, unless you can get the seller to agree to have their loan come alongside theirs, have a private money lender's loan come alongside theirs, that could present the challenge.
Mm-hmm.
Now, maybe, and you'd have to run the numbers, maybe it's a hybrid. Maybe you can have somebody come in as a debt part of the equation, but maybe you sweeten it by giving them some equity in the deal. I don't want to throw out percentages because but it's a math equation. You'd have to kind of run those numbers to figure out like what potentially makes sense. And man, now would be the time, I always talk about dig your well before you're thirsty. Like, the time to raise the money you need is not when you need it, but hopefully, and I know you've been having conversations with people already in terms of what are your goals and how much money do you have? What are you looking for? There's one person in our community that I won't mention his name has or is about to have $500,000 to put into a deal. And I'm not saying this is the right deal for him or not, but hopefully you've been having those conversations and you can pick up the phone and say, hey, listen, I don't quite have this under contract, but here's the loose framework of this. Here's the opportunity, and start having conversations with people. Is that helpful, man?
Very, very, yeah.
What's just as a recap here, what's jumping out at you? What do you love? What takeaways do you have?
That it doesn't need to be a home run in order for it to still make sense as a deal and to attract an investor. That was helpful to hear, and understanding the emphasis on the length of the term for the seller financing, being that this is a cash flow play and just provides more flexibility when it comes time to refinance. So I'm not in a pinch when that time comes, being able to afford the balloon payment, and then talking about some ways to creatively finance it, whether it's private money lender and ways to attract an investor like depreciation.
Yeah. I think some of these things, Dan, that can really give you some confidence is tightening up the offer in a way that gives you, like, I think to the seller, what's most important is the amount of monthly income they're going to receive, correct? Is that right?
Price and monthly income, yeah, were key to them.
I'm sorry, my apologies for the distraction there. What was that?
Price and monthly income.
Okay.
Were the emphasis.
Okay. So build your offer around that. If you're going to give them price and monthly income, how do you make it so that, oh, and by the way, because you negotiated no payments for 1 year, correct?
Yeah.
Which is fantastic. That's huge. I think you and I looked at the spreadsheet, and I think it's generating like 120 grand, 130 grand by the end of year 2 in cash flow?
Yeah, it's 200 grand year 1 without the debt payments, and then it's 141 grand net cash flow after debt service year 2.
Is that right? I thought the numbers were less than that. Are you sure that's right? That doesn't sound right.
That's before paying the private money lender.
Yeah. I'm talking with the private money lender, correct?
Oh yeah, so it goes down to 85,000 year 1, and then 27,000 year 2. So it's much lower, but still a functioning deal.
Yeah.
So and it goes up to about 50,000 by year 5.
I think the next step for you, brother, is have a conversation with the broker and say, hey, listen, I'm serious about this. These are the concerns I have, in terms of the structure of the deal as it relates to the exit. And look at the timeline on your spreadsheet, on the Storage Wins underwriting spreadsheet that you have, Dan, and say, like, how many years would the term need to be for it to have enough equity where you're comfortable on a sale, or you're comfortable on a refi, because you can act on a refi when the rates adjust if you have a long enough term, because I think if you can get 10 to 12, 10 to 15 years on this thing, now you've essentially, I think, given yourself enough room to feel comfortable. And I don't want to make that decision for you. You have to make that decision, but you'd probably make you feel more comfortable on the exit. Right. And now and that's going to make, if you bring on somebody as an equity partner, or if you bring on a private lender, that's going to make them more comfortable on the exit too. So I think it's a simultaneous approach here, two-pronged approach of getting on the phone with the broker today, and then reaching out to those in the Storage Wins community, relationships you've built, to start having conversations about, is there an appetite for this based on their goals and based on what the opportunity sounds like?
Yeah, that all makes sense.
Yeah. All right. Awesome, man. Does this help give you a little bit of clarity and just at least just a little bit more confidence moving forward?
Very much so.
Yeah. Remember, man, at the end of the day, we never want to put all our eggs in a basket. And so detach yourself from the outcome, despite how difficult that may be, because this is your goal and this is what you're focused on. And you've knocked on the door numerous times and you've been very close. Detach yourself from the outcome, which you have very little control over, by the way. Okay? But you put your best foot forward. We don't get stuck in analysis paralysis. We move and operate forward with confidence. Hopefully you have that leaving this, this call. And then we see what's what. And if I don't want you to get into a deal that doesn't have a clean exit, and then you're left scrambling, figuring that out. So make the broker a part of the solution and figure out what that looks like and what it could look like. And if you had to keep all the structure of the terms as is, the 5%, the no payments for 12 months, I don't know what the amortization looks like. Maybe you want to get a more of an amortization now, but you have to figure out what that does to the principal on the back end. Actually, no, because it's interest only, so there is no amortization. Yeah.
Right.
I mean, I'm sorry, not principal only, interest only. So there's no amortization schedule here. But I think if you can extend the loan, the term, or at least have an option to extend, that can really, really, I think, give you some breathing room here. And brother, maybe you sweeten the deal for the seller if price and the monthly income they receive is what's most important. Maybe there's a way to structure this where you're getting a better price, which is going to give you more breathing room on an exit, and you sweeten the deal for them a little bit if need be in terms of the amount of monthly income they're going to receive. I don't know what that looks like, but instead of 12 months of no payments, maybe it's 6 months of no payments, and they start receiving, maybe it's an additional X amount of dollars in monthly income they receive in exchange for a lower purchase price. So some things to consider there. And there's a lot, we could talk about this for hours and hours and hours. There's a million variations here. You got to get on the phone with the broker. I would see if I can get a hold of the seller. And if the three of you guys can put your heads together to see what makes sense, I think that's your cleanest path to figure out if there's a solution here. Sound good?
Sounds great.
All right, brother. All right, man, I got to run. Keep us posted. Share inside our Storage Wins community. Just keep us up to date. And man, you got an army of people supporting you and coming alongside you, man. So anything you need, we're here for you.
Sounds great. Thank you, Alex.
All right, we'll talk soon.
Take care. Bye.